Oh, Natalie's it's sixth edition for ABCs of Money.
Yes.
Yeah, okay, thank you. All right, we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Natalie here with me in the Zoom room. We are ready to begin our presentation on time at 2:15 p.m. That's Eastern Time coming up in just a few short minutes. Thank you all so much for your patience. I hope you're enjoying the show so far. To those of you just joining us, hello, welcome in. We will be getting started here on time in just a couple of minutes now at 2:15 p.m. Eastern Time. Thank you all so much for your patience, and I hope you're enjoying the show so far. Hello, everyone, and welcome to the session. It is my pleasure to introduce Natalie Pace, co creator of the Earth Gratitude Project and author of the Amazon bestsellers, The Power of 8 Billion, It's Up to Us, and The ABCs of Money, 6th edition, along with many more. Now, Natalie's easy as a pie chart nest egg strategies are enthusiastically recommended by Nobel Prize winning economist Gary Becker, former TD Ameritrade chairman and CEO Joe Molia, and over 120,000 people who have transformed their lives and relationship with investing and money as a result of attending her retreats and reading her books. Now, to our live viewers, please share any questions that you may have for Natalie in the chat box. It's located on the right-hand side of your video player. Time permitting, we'll see if we can get to some of those questions at the end. And with that said, Natalie, I'll hand the mic over to you. I'll be here if you need me, but the floor is all yours.
Thank you so much, Charlotte. I may have too much information in this one. I'm going to try to get through it all so we can get to some questions. But just so you know, you can also email me at info@nataliepace.com. And I do think that they allow you to watch this back here at the Money Show as well. So I'm going to dive right in to my PowerPoint because we're basically talking about, look, we had superstars in 2025. Silver outperformed gold. Peru outperformed copper. All of those way outperformed the Magnificent Seven. So we can talk about how to get hot in your portfolio and also ways to capture gains and make sure that you're age appropriate, properly diversified. So easy ways to do all of this. So here is our topic. We're going to talk about a lot of different things. And the main reason is that silver, gold, Peru, and even clean energy were more powerful than the Magnificent Seven in 2025. And since then, now we have to be forward thinking and say, what's going to be hot now and going forward? And some of the ideas that people have, obviously, will Bitcoin recover? What about the Magnificent Seven? Tesla and Microsoft have pulled back quite a lot. What about gold? Is that going to be the safe haven? What about silver? Silver's pulled back more than gold. What about oil with oil prices so high? And I threw in another one to think about, and that's air taxis, because Archer Aviation is the official air taxi for the LA Olympics 2028. Also, cybersecurity, defense. So we can talk about all of these, but we want to talk about them in the context of both what's the opportunity and should you buy it now? I have a really good friend who's also a frequent contributor to the Money Show, Kelly Wright, and he says, hey, stocks are easy. It's just a question of what and when, right? So we're going to talk a little bit more about what and when. In our pie chart strategy, it's never all or nothing, right? So if you keep an age appropriate amount safe, and if you have your at-risk portioned into 10 slices, if the slice becomes 4 slices, it's really screaming at you, sell high and capture gains. And it's not all or nothing, right? Like take 3 off the table, keep that money, and keep 1 in there. And that way, if the price goes down, you can buy more at a lower price. So our pie chart system, which actually is time proven now since 1999, it's simple, it's effective, it's a capture gains policy, and it outperforms the bull markets. And it also protects your wealth in bear markets. So it's a pretty good idea to learn more about it. And I do have a pie chart to show you. But this one chart that I wanted to say, and this is from a couple days ago. Obviously, we're at the 22nd already. Happy Earth Day. So a lot of things have really pulled back. Palantir, Microsoft, Tesla, Meta, Apple. Apple and Nvidia are pretty close to even now. But what we see here is that the best performers can also be very volatile. So having that capture gains policy is really important. But I also wanted to remind you, because a lot of people are like, oh, I lost money on my silver. And no, you didn't really lose money on your silver. You just didn't hit the gains at an all-time high. If you had silver in 2025, it was one of the top performers. If you had Peru, it was one of the top performers. So we're going to take a look at, how that has looked since then. This is that pie chart I told you about. So again, act your age. If you think that there's a lot of economic storms on the horizon, act a little older than you are. 10 funds, small, medium, large value growth, and 4 HOTS. Now, one other hack I'll tell you is that it's super easy to invest in almost everything hot you can imagine in a self-directed IRA. So that's one of the tricks that I really try to emphasize, especially for retail investors. Peter Thiel has over $5 billion in his Roth IRA, according to ProPublica. So we want to start, stop making the tax man rich. There's a lot of little tiny hacks that we can be doing here that are also a way to keep more of our money, more of our gains. So you can get safe, hot, and protected in one easy plan, but we're focusing on those four hot slices here, right? Um, so is the Magnificent Seven now the Fantastic Five, right? Because we have seen a major pullback in both Microsoft and Tesla, and there is a bit of a difference between the two. What about AI? What about our crystal ball tools, the forward outlook and the earnings calls and all of that? So basically, what we've seen is that the Magnificent Seven has been the drivers on Wall Street in 2023, 2024, and performed brilliantly in 2025. But they're also very volatile. They were the worst performers in 2022 when the S&P 500 pulled back almost 20%, 19.44. We saw the NASDAQ Composite Index drop 33%. Nvidia dropped by 50%. Tesla and the ARK Innovation Fund, that it has a lot of these technology stocks and these big, magnificent $7 trillion companies, dropped 67%, as did Bitcoin. So again, having a strategy that captures gains so that if we do hit weakness, because the higher they soar, the faster they can fall and farther that they can fall. And it's just important to realize this. It doesn't have anything to do with will we, want to buy more Teslas tomorrow? Will we give up our iPhone? Will we stop using search? Will we stop using Microsoft Suite? Will we stop using WhatsApp and Instagram? It has more to do with the fact that whales, Wall Street whales, like taking profits. That's where we see the volatility. So when it soars really high, it's like, okay, I'm ready to take some profits, and then boom, right? And retail investors can get caught on the wrong side of the trade if you're not in that capture gains mindset. So one of the biggest concerns on the Magnificent Seven is really valuation. And I want to especially emphasize Tesla here. So I want to show you another screen. This is on the money page of MSN. So you can see here that Tesla's revenue has stayed pretty constant over the past few years, but what has changed a lot is the net profit. So it was 15 billion in 2023, and it got cut by half in 2024, and then now it was less than 4 billion in 2025. And the question is, should a company that only has 4 billion in net profit be worth 1.5 trillion dollars? So when you start seeing a price earnings ratio that's 376, and we're going to talk about the growth or not in Tesla, that's a pretty lofty valuation. And that does mean, and we have seen obviously a lot of volatility in Tesla's share price as a result. So again, I already told you this, that the Magnificent Seven were really the all-stars. And if you didn't have large cap growth, we actually were emphasizing Magnificent Seven, not just in large cap growth, which could be 70% of many of these large cap growth ETFs were the Magnificent Seven, but you could also just get really targeted, whether you chose AI or breakthrough technology. It was going to be heavily concentrated in the Magnificent Seven. They also excel in the emergence of quantum as well. So, it isn't a bad idea to have an extra hot slice of them and or of cybersecurity. But again, they were the worst performers. And this is just a chart showing you what I already told you. You can take a screenshot if you'd like, or a picture. And then this is, the S&P, as I said, it was only down 19.44. That's the large stock area. We have talked in the past about the problem with long-term bonds, both duration and credit risk, but I think it's important to remind yourselves that those paper losses are more problematic than you might be thinking. So Tesla's 1Q 2026 deliveries were actually down sequentially. They are up year over year slightly, right? So what's in store? The earnings are going to actually be at the end of today, market's end of today. And I do a little Tesla math. So if it comes in the way that I'm anticipating, then you're going to see that it does have a little bit more year-over-year revenue. It's going to be smaller sequentially because they had fewer deliveries, as you can see, a lot fewer, right? 14.4% fewer. And the net income will be lower sequentially. It should be because they had fewer deliveries, but it will be higher than it was in the first quarter. Now, as you know, investors are forward thinking, so they're also going to be thinking about, well, what about the future? And there are two headwinds for Tesla. One is that when the economy slows down or when there's too much debt, and we are starting to see a little bit of the car loans delinquencies creep up. So when, budgets get constrained, one of the areas that are the hardest hit is the auto industry. There's no, a very high correlation with the bankruptcies that we've seen in recessions. And we're not expecting a recession this year. Everybody's still expecting growth so far, unless, of course, the high oil prices continue because they are highly correlated with recessions. But when the economy's slowing down and people are spending too much at the gas pump, they can't buy a new car. The second thing is, and this is why, even though the actual sales of Tesla have remained strong and it's still a beloved brand around the world, um, the net profit has gone down because they had to lower prices to compete in China. We could talk about that at greater detail, but basically China is the largest electric vehicle market, and they have literally hundreds of Chinese electric vehicles, some of which compete directly in that luxury space with Tesla at a lower price point. While we can't buy those Chinese EVs here, they can buy them in some European countries, in Mexico, and they may even be able to start buying them in Canada. So this is also something that's a little tough for the main driver of Tesla's revenue right now. I know they're trying to, push forward on full self-driving. They have a strong, the AI, just FYI, the XAI, that's going to be part of the SpaceX IPO. It's not attributed to Tesla. They actually do have AI, obviously, in their cars, and they have the Tesla Vision, but there's a lot of auto industry CEOs and experts who believe that LiDAR is essential for full self-driving and for robo-taxis. And that's something, Tesla's been relying upon Tesla Vision. So if you would like to see a NASA engineer show the difference between those two technologies, email info@nataliepace.com and we'll give you a link to the blog I wrote about Waymo versus Tesla. And you can actually then link to the YouTube. It's kind of entertaining little video, little Wile E. Coyote moment in it. So very much something we encourage you to do. And the reason for that, again, we just talked about it, is the Chinese EV competition too much for Tesla. You can see that the year-over-year sales growth on a lot of the Chinese companies is a lot more robust. In the last quarter, Tesla's sales growth went down. Year over year, it's up this quarter. So I talk about Waymo versus Tesla, or air taxis versus helicopters, creative disruption, because that company that has the leading edge technology can really wipe out everything else. So you've seen how high NVIDIA soared to the top of Wall Street, one of the most valuable companies on Wall Street, worth almost $5 trillion, versus Advanced Micro Devices. We saw how BlackBerry is almost buried and Apple iPhone is the thing, although Samsung sells more units than Apple does. So it is that breakthrough technology that is the key for the superstars. And we always want to have our eye on that sort of thing. So again, Tesla is worth more than GM, Ford, and Toyota combined, a lot more. Apple is worth clearly a lot more than BlackBerry. NVIDIA is worth a lot more than AMD, and it has to do with breakthrough. Who is the one that makes that innovation that the whole industry is going to have to chase after? So, and I'm going to have to do an article on this. You guys might have already seen that Apple lost their CEO. And what's newsworthy about this is that usually we get more advance notice. I'm always a little skeptical when the CEO jumps ship right before an earnings call rather than announcing it I mean, he's not leaving until September, but it just seems a little abrupt. So I am going to try to do a little digging and see if there's anything there. Look, the truth of the matter is I'm talking to you on Zoom, which I mean, the Zoom presentation, but it's on a Mac computer. I have an Apple iPhone. It's pretty impossible for me to have this kind of like seamless interaction between my iPhone and my computer if I tried to stick Samsung or PC in the mix. So a lot of us who do have Apple products, I don't see that going away soon. Let's put it that way. And they're getting pretty good about trying to charge us for everything like more storage and Apple TV, and their services segment has gone really crazy. But again, do keep an eye out or make sure that you're part of our mailing list so that you get that blog. I do think it's worth looking into why do I think Tim Cook jumped ship so fast, which is a little abrupt, but I guess it always feels abrupt when we have a succession plan that moves forward. So I just want to remind you that Apple is not the number one smartphone provider by units in the world. It's got 21% of the marketplace. Samsung is number one, and we actually saw a prior competitor of Apple's that had really good technology at a much lower price point was Huawei, and we are seeing that making inroads mostly in China. So, what about copper? What would make copper prices fall? So, right now, again, we were selecting Peru, and that proved to be a great bet. Peru is the second largest exporter of copper, and we thought, hey, high copper prices are going to definitely bolster the Peruvian economy. It doesn't mean that it's without risk, right? They do have labor issues. They shut down a mine there, but the bottom line is that copper prices rose, at like a third of the amount that our Peruvian ETF rose. Now, what's going to happen in 2026, 2027? Unless there's a recession, then Dr. Copper phenomenon hits in. What's expected to happen right now is that it's still very high demand because copper is used in all technology and energy. It's called, Goldman Sachs was very famous for saying that copper is the new gold. And we also have some supply challenges. We just can't keep up with the demand. So they are expecting not prices to skyrocket, but to stay elevated. Now, if there's a recession, a lot of that building projects and all of these things that were, that would need copper, they had the kibosh put on them. So that's why it's called Dr. Copper, because when we see copper prices plummet, that tends to precede the recession. We don't get the recession warning for usually 7 months minimum and after it happens because we do, the feds are always going to wait for 2 quarters of contraction before they call it. So, which companies and countries? Again, I think that for most people, most of us, a far, even a managed plan, honestly, not even if you're just self-directing. It's a far better idea. These days, you can have an ETF that is just Peru. You can have an ETF that's the Magnificent Seven. You can have an ETF that's cybersecurity or AI. So it's always a good idea. A lot of those are going to be anchored by the superstar, but it's also going to have other companies in there. And for most of us, since we're not, making this our job, and even if you are making it your job and you don't have, over a decade of experience, it's a very good idea to have the extra protection that comes with a fund rather than just having that individual company. And we're still leaning into Peru, but we definitely, again, it more than doubled last year. So definitely take profits and, keep the slice where it should be in an age-appropriate diversified plan. That way, if Dr. Copper phenomenon kicks in, instead of selling low, you can buy low. You have the both the liquidity and the emotional fortitude to do so. So oil and gold are both commodities, and in terms of what will cause them to sink or soar, you have heard a lot of talk that if the war in Iran ends, that oil prices will go back to where they were in this kind of $65 a barrel range. That will help, and that will help the economy again. If oil, the problem with oil and chasing it, and by the way, if you made a lot of money because you happen to have a hot slice of oil, I would consider, capturing gains. And the reason for that is that high oil prices are definitely going to make the next quarter look good. But if the war ends and prices go back down, then the quarter after that will not look as good. And investors, especially the whales of Wall Street, are all going to be forward thinking. They're not going to say, oh, this earnings report is great. They're saying, okay, this one was good, but what's the next one going to look like? And they know how to do math, right? So I think that's important. Now, what if the war continues? Won't that be positive for gold? And the answer is no, because high oil prices are highly correlated with recessions. So the longer that we have high oil prices, the more greater at risk we have a recession. In recession, people don't spend as much money on oil because they can't afford anything. They might be hanging on to their job for dear life. So either way the wind blows, it's not necessarily great for oil prices to remain this elevated. It's just too hard on consumers. And in terms of gold, I think that a lot of gold bugs and maybe even some cryptophiles have the same issue. Put it in your hot slice. And that way, if gold doubles or triples, you can capture gains. You can still keep game on if you think that it's going to shoot the moon. But these are volatile. The people who tell you that they don't go down in value, that is just not true. I do have a blog on this that you're welcome to look at that talks about the history of gold, silver as well, crypto as well. And basically just go to nataliepace.com/blog and you'll see a lot of it. So I just did gold, silver, and crypto because the safe havens were going down in 2026. And hot countries, I talk about our hot slices in the most recent one is all about HOTS when superstars burn out because we did have Microsoft and Tesla pull back so severely. So I've also been hearing a lot of people say, "Oh, well, central banks and governments have been secretly buying gold." But the truth is, U.S. and Europe are pretty steady investors. Retail investors have been interested in gold, so we are seeing a tick up on retail investors. We are seeing a little tick up with China. Russia actually had to sell some. So I think it's just important to make sure that you're actually getting your data from a data provider instead of a marketer who just wants to sell you into a gold IRA. So what do I think are hot? I mean, a lot of the same things look hot to me. Copper, but play it as Peru. I do think that there's a lot of fear, FUD, in the market, fear, uncertainty, and doubt. And so this safe haven, which prices are volatile, so I don't call it a safe haven, but that bet, that emotional bet, I still think that silver is a better play. You want to have a capture gain strategy. We say once, twice, or three times a year. And in my financial freedom retreat, we talk about when would be a strategic moment to do that. But that's what you want to do so that when it does pull back, you don't say, oh, I lost money. So, prices are high. Obviously, we just hit another all-time high. It's easy to make money in a bull market. It's easy to lose money in a bear market. So don't confuse a bull market with wisdom. You do want to have a plan that can work no matter which way the wind blows. Stocks are very expensive. This is the CAPE ratio. You can take a picture and Google that if you need to learn more about that. So in the late stage of the business cycle, or at a time when stocks are at an all-time high, very elevated, and a slowing economy, ask yourself, what can the company do? What is the industry likely to do? And what is the marketplace going to do? Because the marketplace, as we saw in 2022, which was another midterm election year, like this year is, the marketplace went down and it drug down everything, but the ones that went down the furthest were the ones that had the highest score before. So bear that in mind and just make sure if you have not rebalanced, April's at the end of the spring rally, and that's not a bad time to get you're rebalancing in. And we actually are having, oh, I put in the June one. Let me show you. We're having a retreat this coming weekend, a financial freedom retreat. And it's online, so you can attend in your pajamas from anywhere. Email us at info@nataliepace.com. So day one is nest egg strategies. Day two is how to get super hot. And day three is what's safe and how to get safe. This can help you to make sure that you put in place an age appropriate, properly diversified plan. Of course, you can read about it in my books. You can learn and implement it at the retreat. And if you need help and want an unbiased second opinion, I don't sell financial products. I sell financial information, wisdom, time-proven systems. I'm on the education side. I'm happy to give you an unbiased second opinion because I'm not going to try to sell you a financial product. I want you to know what you own so you can be the boss of your money. It's your money, no matter who is managing it for you. So, yeah, then we're having a preparing for retirement class in June. So, if any of this is speaking to you, I do in interviews with industry professionals. You definitely want to check those out on YouTube. Natalie Pace on YouTube, Natalie Pace on Substack. So yeah, I think we can kind of stop there. In general, yes, Magnificent Seven, yes, Peru, yes, silver still, yes, clean energy still, but capture gains a lot. If you invested in them in 2025 when we had them listed as HOTS, you're in a position to have some good bank on capturing your gains and still keeping game on. So Charlotte, are there any questions?
Thank you, Natalie. I'll give the audience a moment here to catch up with us. To those watching us live, feel free to share your questions now in the live chat box. While we wait for that, Natalie, any frequently asked questions or something that maybe you didn't cover today that you think our audience might benefit from hearing?
Yeah, in fact, I wanted to go back to it anyway. I want to let you know that you could actually personalize your own sample pie chart using our strategies. We have free web apps. So you could just email info@nataliepace.com and get that. Let me just show you because there is a difference, obviously, what age you are, right? If you're 30 or if you're 50. So these are sample pie charts. This is a 30-year-old who's overweighting safe because they think that maybe we could have, a weak year like we did in 2022. This is a 50-year-old. And again, all of this can be done quite easily. You just answer, and you don't even have to go through us. You just go right to the web app and answer four easy questions. And then boom, it'll create your own pie chart for you.
Fantastic, Natalie. Thank you so much. It looks like we still don't have any questions from the live audience. I guess they're just really listening into everything that we're saying.
It's a lot. It is a lot. Well, I guess what I would say is that, a lot of people are wondering how the economy is so strong. I think this is kind of an important thing to understand is that, productivity has been very strong because if you think about it in your own life, if you're actually using AI to help you write something or AI to help you fact check something, this is actually making everything can be done super fast. And that is productivity growth. So that AI has been definitely moving forward the economy. It's been keeping the economy strong because the US is very strong in AI. So is all of this spending that has to go on data centers and obviously energy projects. And I think that's another thing that I wouldn't mind telling your audience is like, the reason that clean energy is doing so well, part of it is that a lot of these companies, these trillion-dollar companies, they have net zero goals for 2030. That's 5 years from now, well, 4 years from now, right? And so when they're building data centers, they're trying to power it with renewable. It's not possible. They have to build them so fast that they still have to do some grid and some natural gas, but a lot of them are really trying to do it clean energy wise. So that's where we're seeing a great deal of investment. Also, even homeowners, when you see that your electric bill goes up way higher just because oil and gas prices went up, that makes solar, rooftop solar, more interesting for homeowners too. So that's part of the reason why. It's a lot of volatility in the individual companies of solar, wind, and other clean energy, which obviously also includes electric vehicles. infrastructure for charging, that sort of thing. It's so I wouldn't necessarily pick one to invest in because they are very volatile. Boy, if you think gold and silver are volatile, clean energy companies are really volatile. And but you know that ICLN, that's an iShares global clean energy ETF, that's performed extremely well this year.
Thanks, Natalie. And I know that we're right up against time here, but we did get some questions in the chat. So I'll try and just squeeze one in from JJ. He's asking, what do you think the S&P 500 performance by the end of the year will be?
Well, you know, I like to go by the analysts, right? So earlier this year, the analysts were saying that it actually could improve 16% from where it started, right? And that's actually slowed down from what it did in 2023, 2024, and 2025. Those were rock star years for the S&P 500. But as I said, I think you should be cognizant that as long high oil prices are very highly correlated with recessions, which means that instead of having, you know, the S&P 500 increase in value, it can decrease in value. We did see that in 2022, which was a midterm year. And I will say this, midterm years are not great, right? 2022, it was down 19 point, almost 20%, the S&P 500. And in 2018, it was down 6.4%. So the prior two midterm years were negative for the S&P 500. When I asked this same question of Google AI, Google AI, because of course I do a lot of this analysis and I'm in contact with the S&P 500. My, for many years, Howard Silverblatt, the senior index analyst. But AI said there's a 70% chance of a correction, which would be minus 10% based on it being a midterm year. So now you have it all over the map. Could be minus 10%, could be plus 16%, could be minus 20% if it goes as low as it did in 2022. And when you have data that goes around, there's a famous quote, I'm sorry if we're going over slightly, by Andrew Lo, and it says there are three laws that in the natural world and physics that explain about 98% of what happens in the natural world, and there are about 98 economic laws that can explain about 3% what happens in economics. So it's really like economists are terrible at predicting recessions and corrections. So what I would say is age appropriate, properly diversified, get hot, but have a capturing gains strategy. It works really well, no matter up or down.
Natalie, thank you so much. It's been a fantastic presentation and glad that we could get at least a little bit of Q&A in there at the end too.
Yeah, thanks, JJ.
Absolutely. And to the rest of you watching live, be sure to stay tuned. Thank you for watching today. We do have more in store for you in this Money Show Virtual Expo. If we did not get to your question, if you still have questions for Natalie, be sure to reach out to that info@nataliepace.com. Also, if you're interested in the retreats that she mentioned earlier during her session. And with that said, I hope everyone has a wonderful rest of your day. Take care.
Thanks, Charlotte.